It's been another tough session for Lithium Americas stock. As of late afternoon Monday, shares are down about 9%, trading just above the $6 mark. And yet, there's no single piece of catastrophic news that explains the move. Instead, this decline seems to reflect a mix of ongoing pressures, analyst downgrades, volatility in the lithium market, and a shift in investor sentiment across the entire sector. Let's unpack what's really going on here. The first point to note is that Lithium Americas, ticker symbol LAC, has been one of the most volatile names in the critical mineral space. After rallying strongly through September and early October, the stock has now given back much of those gains. And the sell-off we're seeing today feels more like a continuation of that correction than a reaction to a specific headline. One of the recurring themes driving this pullback has been analyst sentiment. Over the past month, both TD Cowen and JPMorgan issued downgrades on LAC. TD Cowen cited valuation concerns after the stock's big run-up, while JPMorgan argued that the company's strategic importance to the U.S. government doesn't necessarily translate to near-term shareholder value. Their reports pointed to several challenges: high capital expenditure, long project timelines, and persistent negative cash flow. Those downgrades landed in a market that's already nervous about commodity pricing. Lithium prices surged earlier this year, but by late October they'd pulled back sharply. Spot prices in China, which often lead global trends, have retreated from mid-year highs as concerns about oversupply started to resurface. Producers have been increasing output again, and while demand for electric vehicle batteries remains strong, supply growth has outpaced short-term consumption. That imbalance has caused volatility across the board, and LAC has been swept up in it. The second factor is the evolving narrative around the company's partnership with the U.S. Department of Energy. Back in October, Lithium Americas finalized amendments to its roughly $2.23 billion loan agreement for the Thacker project. The update included the deferral of about $184 million in debt service to later years, a move designed to support early-stage cash flow flexibility. The company also disclosed that it had received its first drawdown from the loan, totaling around $435 million. And importantly, the DOE confirmed a 5% equity stake in LAC and its joint venture at Thacker Pass. On paper, that's an enormous vote of confidence. It's a clear sign that the U.S. government views this project as strategically vital to domestic lithium supply. But in practice, it also raises the bar for scrutiny. The more public funding that's involved, the higher the expectations become. Investors know that any changes, delays, or cost overruns will now play out under much brighter spotlight. So while the loan and the equity stake strengthen the project's financial foundation, they also increase visibility. And in markets like this, visibility can sometimes magnify volatility. Adding to that complexity, the company has yet to meet all the customary conditions required for those loan amendments to take full effect. That lingering uncertainty may be adding to the nervousness we're seeing reflected in the share price. Beyond the fundamentals, there's also a technical story unfolding. Earlier in the month, LAC breached a key support level around 750. That zone had previously served as a floor for buyers during pullbacks. Once it gave way, it opened the door for algorithmic and momentum-driven selling. Technical traders now see the next significant support around the $6 mark, which, interestingly, is where the stock has been hovering for most of today's session. Now, let's talk about sector sentiment. Over the past several weeks, other lithium producers have announced expansions or production restarts, which on the surface might sound bullish. But in the current environment, that kind of news actually fuels the oversupply narrative. Investors worry that if everyone ramps up production simultaneously, prices will remain under pressure. That perception drags down valuations across the space, even for companies like Lithium Americas that aren't yet in full production. There's also an operational dimension to this. While LAC has strong liquidity thanks to the DOE loan and previous capital raises, the company remains pre-revenue. It continues to post negative profitability and negative operating cash flow. That's normal for a project at this stage, but it makes the stock more sensitive to shifts in interest rate expectations and investor appetite for risk. In a market where capital is becoming more expensive and patience is wearing thinner, pre-revenue stories often get punished first. And that's what we're seeing now, a re-rating of long-duration assets as investors look for near-term cash flow instead of future potential. If we zoom out, there are a few other forces at play that are harder to quantify but worth acknowledging. The entire clean energy and battery metals trade has become politically and geopolitically sensitive. Tensions between the US and China over rare earth exports have flared again, and the supply chain narrative is shifting from excitement to execution. Investors who once saw the U.S. government's involvement as a safety net are starting to realize that it comes with strings attached: accountability, oversight, and deadlines. That realization can be uncomfortable, but it also represents a step toward maturity for the industry. So where does that leave LAC? Despite today's decline, the long-term thesis remains intact. Thacker Pass is one of the largest known lithium resources in North America. The project still has federal backing, a partnership with General Motors, and strategic significance for U.S. energy independence. Those fundamentals don't disappear because of a bad trading day. But in the short term, the market is sending a message: it wants clarity. Clarity on costs, clarity on timelines, and clarity on how the DOE relationship will evolve now that the government has an equity position. For investors, that means the next few updates from the company will be crucial. Any progress report on construction milestones, permitting, or drawdown timelines could help rebuild confidence. On the flip side, if communication remains sparse, sentiment could stay weak. From a technical perspective, the $6 level is now the immediate line in the sand. If it holds, we could see a short-term rebound or at least a period of consolidation. If it breaks decisively, the next area of support doesn't appear until closer to the 550 range. But price aside, what really matters is the broader question: has anything structurally changed about the company's ability to execute its plan? So far, the answer appears to be no. The loan is still active. The project is still moving forward. And the U.S. government still has a vested interest in seeing Thacker Pass succeed. That doesn't mean the road will be smooth, but it does mean the foundation remains solid. One other factor worth mentioning is investor psychology. After a volatile few weeks, many traders are simply de-risking. We've seen funds rotate out of high beta names and into defensive sectors. That trend is amplified by algorithmic strategies that respond to volatility signals. In plain terms, when momentum turns negative, it often stays that way until a clear catalyst reverses it. For LAC, that catalyst could come in the form of a project milestone, a favorable analyst note, or stabilization in lithium spot prices. Until then, it's a game of patience. And that's what makes this story so fascinating. Lithium Americas sits at the intersection of government policy, industrial strategy, and investor psychology. It's part engineering project, part geopolitical bet, and part market sentiment play. Few companies are exposed to as many moving pieces, which is both its biggest risk and its biggest opportunity. If the company executes on its plan and meets its DOE conditions, the long-term payoff could be enormous. But in the short term, it's vulnerable to every shift in sentiment, from lithium price forecasts to analyst opinions to trade headlines. In many ways, what we're witnessing isn't a company-specific collapse but a sector-wide reality check. The easy phase of the lithium story is over. Now comes the hard part: delivering results. And that's the lens through which investors should view today's decline. It's not necessarily a sign that the thesis is broken. It's a reminder that the path to building a domestic lithium industry will be uneven. But those who can stomach that volatility and focus on the long-term need for U.S. lithium production may find that these moments of pessimism end up being opportunities. In short, there's no single headline driving this 9% drop. It's a combination of technical pressure, analyst caution, lithium price weakness, and a general recalibration of risk. But beneath the noise, Lithium Americas remains one of the most strategically important pieces of the U.S. energy transition puzzle. If anything, the volatility reminds us that building the future rarely happens in a straight line. For LAC, the mission hasn't changed, only the market's patience has. And patience, right now, may be the most undervalued asset of all.